Yeah, I don't know if you've been paying much attention to like the price of Netflix stock. It's pretty volatile. You could say Netflix stock has been doing amazing over the past 6 months. You could look at it in that light, or you could say Netflix stock has been doing terrible if you go back a year, 2 years. So that's the problem when you just look at price. It depends how far back you go. If you look at it over a month, sometimes it's up. If you look at it over a couple months, sometimes it's down. And I do see a lot of investors falling into the trap of saying, oh, the stock's doing terrible because the price is down over the past couple of months. But I really do think that it's a lot smarter to just look at the underlying business, which actually brings to mind that famous quote from Oscar Wilde: all the cynic knows is the price of everything, but the value of nothing. So I guess what we try to do on this channel is at least try determine the value of a stock. We're not saying that we know for sure that this is like the exact value. So, Lee, do you like Netflix stock? What do you know about it? Should we just get into just the basics of the business first?
Yes. So, I mean, I'm pretty sure everyone knows like roughly what Netflix is. Like, it's a company, like basically just like subscriptions for viewing movies, films, TV series. I don't actually have a subscription myself, but I know a lot of people do. The amount of users they have is, I think, roughly 240 million. And in terms of competitors, they've got, or the two big ones are Disney Plus and Amazon Prime. So Amazon Prime obviously is kind of like it's people who are also using Amazon Prime for other things like free shipping for the Amazon stuff. But Amazon Prime has 200 million users and Disney has 160 million users, which is actually much more than I thought it would be. I
Damn,
was surprised with that.
that's a
Yeah. So
lot. I thought
yeah, it
Netflix
is.
was just dominating them in terms of users, but what Netflix is 238, and what did you say? Prime was 200.
Yeah, Netflix 240, Prime 200, Disney 160 million.
Huh? You're getting close.
Mm. So it's like the space is shared between like three big players at the moment, from what it looks like.
I always used to think that Netflix was just well ahead of the pack. And maybe they were like 3, 4, 5 years ago. I'd love to know what that number was 5 years ago. But obviously, Disney and Prime have caught up a lot. And yeah, so those are the two big ones, eh? But there's a lot more than
Mm.
just that as well. Like there's Hulu, there's HBO. You got the big dog coming into play now, Apple with Apple TV, and they're really making some big moves. You often see it here and there with different sponsors, like they're sponsoring like the MLS now with Lionel Messi. And they were sponsoring like James Corden and his whatever it's called, carpool karaoke. Like they're making the big moves in the game. And I was even thinking about it the other day. It's not just those traditional streaming platforms, it's also the traditional media as well that they're kind of competing with. Like, CNN and Fox News have come into play offering their service, and they do documentaries and stuff like that, somewhat competing against Netflix in certain areas. So it's a competitive ball game now, isn't it?
Mm. Yeah, especially, yeah. So I suppose, I mean, one way we could break it down is like two parts of the business, right? Like they create their own like original content. And that one they're competing against all like the legacy media, like Fox News, CNN. And then the other side is the platform. And the platform is a strong, like I mean, it's a strong company in the sense that like you own the network. The operating cost for it will be relatively low, and like you'll get like relatively high income from the people that are like paying subscriptions on the platform. So that side of the business, yeah, that side of the business is competing against, I think, more like, yeah, as you say, like Hulu, Amazon Prime, Disney Plus, and the other side, like creating original content, that's competing against the legacy media.
I don't get the distinction between the platform and the content, because isn't that the same thing?
Oh,
Like they
right.
have they have the platform and then they just put content on that platform. So isn't that just the same thing?
Yeah, so some of the content on their platform they license. So there'll
Oh,
be
I see.
like other companies which create the content,
Oh, I
and
got
then
you.
Netflix just like put it on their platform. And I think I don't want to be telling a lie here, but I think they used to put like Disney content on their platform, and then Disney was like, ah, screw this. Like,
Mm.
like we're doing all the hard work creating the movies and stuff, and then Netflix are coming in, they're paying us for the movies, but they're getting like a big cut themselves from owning the platform. So Disney's like, screw this, we'll just create our own platform. and now Disney like have, like their own network effects going on there.
That's super interesting. I can't remember what the word for what you talked about those type of businesses last week.
Stalwart.
Yeah, that's very interesting because it shows you how a stalwart company operates. They're slow. They've been around for so long that they wait until it's blinding them in the eye that it's obvious that they need to create their own network, their own streaming service, and then they do it. So Netflix were doing it. They were making a ton of money. They were doing it for ages. Even Disney was selling them their content. And then they finally clicked on and they made their own streaming service.
Yes. And just to back up your argument there about the stalwart company, I'm going to quickly share my screen. So now we're looking at the number of paid Netflix subscribers worldwide. And you can see like from 2013, they've kind of got like decent growth. It's almost looking exponential. And then weirdly enough, almost around COVID, it seems like the growth has started to like stagnate and drop off a little bit. Like they're not getting as many new subscribers. And the other thing I noticed was in this chart here, this is taken directly from their latest financial report. And the cool thing that it shows, and they've actually been showing this in their financial reports for years, is the paid net membership additions. And you can see like 2020, they had 36,000 like new subscribers. 21, 18,000, 22, 8,000. So like the amount of new subscribers that are coming in is dropping off worryingly.
They had a bad year in 2022. Well, the thing is, they could have just had they had amazing year. I'd love to see what they had in 2019. I'll say that because I know in 2020 and 2021, a lot of these type of companies did extremely well when the whole world closed and people were just on the internet. So I'm not surprised they had amazing years in 2020, 2021, and then it dropped off slightly. I'd love to know what that number was in 2019.
I looked at the number. I don't have it on hand, but I looked at the older reports because like the 2019 report showed that, 2019 and the previous 3 years. And like basically for a long time, it's just been going up. Like it's been growing faster and faster. And then only like the last 2 years, it started like slowing down. Like the growth rate started slowing down. So that could be like a bit of a worry if you're like looking at it. If you're expecting it to grow at the rate it has been growing.
Exactly. So that's just basically something you need to take into account when you do the intrinsic value calculation, essentially with regards to future growth. Will they keep growing at what they did over the past 10 years? Well, there's some worrying signs that they probably won't.
Yes. And then the other sign of a stalwart company is what you were just talking about, this bit down the bottom. Average monthly revenue per paying membership. So you can see in 2020, it was $10.91. And then it moved up a bit, 2021, moved up a bit again in 2022. So it's like the number of customers they have is like growing more slowly. The new customers that are joining is growing more slowly. And they're extracting more and more revenue from each customer, which I mean, on the like financial charts, it's going to look good. But from a business side, it's kind of like they're trading in like their credibility with their customers for just like revenue.
So yeah, that's basically the basics of the business model itself. So actually, when they first started, they were a DVD by mail company. So you can kind of imagine what the business was back then, 20 years ago, where they were competing against, companies like Video Easy. I don't know if any of you guys remember when you used to go to the video store on a Friday night and decide which video you would get. And then Netflix was like, oh, I'm going to be innovative. I'm going to send the DVD by mail, so you don't actually have to go into the store. And then obviously it evolved into just, let's just put it all online, so you don't even have to get physical DVDs. It's an easy business model. Let's be honest. Such an easy business model to get your heads around. They have a streaming service, and then they charge money per month if you want to join it and watch the content that they put on there. Recently, they came out with their ads section of the business model, which basically means you pay a cheaper amount, which is only $7 a month, but you get ads on the platform as well. So they'll get both revenues from the subscription and also the ads. If you don't want any ads, then you have to pay around $15 a month. And recently, another thing just to note down is they have cracked down on password sharing. And so they think this is going to add extra subscribers because you can't share your password and give it away for free. The people will actually have to pay individually to access a Netflix account. So some of the pundits are saying, oh, this is such a good thing for Netflix stock. It's going to add more subscribers. I don't know if it's going to be an amazing contributing factor.
Yeah, that's the exact same thing, right, that you see with stalwart companies where it's like trading in your credibility with customers just to get more revenue. So like the customers aren't going to be happy with that. And Netflix, of course, are going to make more money in the short term when they do stuff like that. They stop people logging on the same account from different locations.
Right.
Obviously, they're going to make more money, but is it a good long-term strategy? I'm pretty sure not.
And the last point I'll just make about the actual business of it, which is something that I don't love about the business, which is the fact that each year they have to put in a lot of money to keep creating content or buying content or accessing content to give to the users. The users of Netflix expect new content to keep coming out and coming out. So if you want to keep making revenue continually, you have to put your chips back in every year and put all of this money back in every year, which is not my ideal business model. I like the business model where you put your money in up front one time, and then you just receive cash flow and cash flow and cash flow, kind of like a railway. Think of a railway. Okay, you build the railway throughout the whole country, and then just for the next 20, 30, even 100 years, you're just getting revenue. And that's the type of business that Buffett loves. Whereas Netflix, it's like every year, okay, we've got to buy content. You just got to keep putting money back in. I don't love that, but it's not necessarily saying it's not a buy or anything. It's just not ideal.
All right. So just following on from what Tristan said in terms of how they have to constantly put money into the business. Now, if you spend some time looking at the financials, you can actually see this happening. And it goes back to the old classic, like look at the difference between free cash flow and net income. So if you just have a look at these numbers, like 2022, they got like 1.6 billion in free cash flow. And then 2021, it was negative free cash flow. You go and you look at the net income, 2022 was positive 4.4 billion, 2021 was positive 5 billion. So there's a big difference, right, between what their net income is on paper versus what the free cash flow, which is the net cash coming into the business. 2021, 5 billion net income, but they had cash flowing out of the business.
So why is that?
Right, good question. And like in the income statements, you are recording only depreciation of assets. At the same time as they're getting like some depreciation, they're also taking cash out of their bank to create new content for the future. And the amount of cash that they're taking out of their bank to pay for new content in the future is greater than the depreciation amount.
But wouldn't that cash that you take out for new content also be an expense as well in the income statement?
No, because it's capital expenditures.
Oh, okay. I 100% understand that.
Yeah.
So that's under capital expenditure, which is actually
Exactly.
which is not in the income statement.
Yeah. All right, so let's get into intrinsic value. So we discussed the difference between free cash flow and net income. I think for the starting free cash flow, I'm just going to use the latest trailing 12 months, which is 4.2 billion. Growth rate, relatively simple. We've done it a few times before now. I'm just going to look at total revenues, display them as growth rates, and you can see it's been hovering at around 20% for a while, dropping off a little bit recently. My guess is like based on like what we saw in the trends we looked at earlier, and the fact that they're already relatively big, like 200 million users with some competitors. I don't think it's going to keep growing at 20-something%. So I decided to go with 15% for my future growth rate. And we'll stick years to forecast at 7. Terminal PE, I think for me, a fair terminal PE would be somewhere around 15, because in 7 years' time, it's going to be kind of like I would guess it'd be like a more stagnant company. It wouldn't be something that I would expect huge growth from. I'll leave the starting cash flow the same, and that's what we get for the company intrinsic value. So from my calculations, it seems like it's probably like a little bit overvalued right now, and it probably wouldn't be something that I'd want to invest in.
So I guess you could say the big question with Netflix stock is future growth. That is the major thing as a potential shareholder. That's what you need to decide. They're sort of in a similar dilemma as Facebook. They're so big, like 238 million subscribers, except with Facebook. These are paid subscribers. These are people paying $7, $10 a month. How much more can they grow? Maybe over the next 10 years, they can double. but they're not going to just keep doubling and doubling and growing at these crazy rates that they were growing by in the past, especially with increased competition like Disney and Hulu and HBO and Apple and all of these competitors now. How much more can they grow? Can they keep growing at the 25% rate per year? Nah, I don't think so. I really don't think so. 20%, no. Maybe 15%, maybe is what you did, 15%. Maybe it's 10%, maybe it's lower. And is it even just as a user though? Just think about it from your perspective. I'll give you my perspective as a user. I've only used it once for 1 month, and this was a couple of months ago. And honestly, a lot of the new content that they're putting out I really don't think it's that good. I watched some of the older content. I used to watch a couple of episodes of Stranger Things. I thought that was really well done, and a lot of people do. And Peaky Blinders, like a lot of their old content was really good, high effort stuff. But I don't know if this is just me, but a lot of the new content I can barely watch for 10 minutes. Like Black Mirror and some of these new shows, they have no effort put in, or it doesn't seem like the shows have had a whole lot of thought behind them. Lee, have you watched much of these new Netflix shows?
The only subscription I have is YouTube Premium. That's
that's another good point. They're even competing against YouTube Premium now. People were like, okay, do I want to pay for YouTube Premium or do I want to pay my Netflix?
You get creators like Mr. Beast as well, who's spending like, millions of dollars on each video, which is like, that's like starting to compete with budgets that Netflix would have. So
true. And that's the beauty that the YouTube have going for them. They just have these creators that are spending their own budget to put their content on their platform. So they're just getting essentially free content. And sometimes this content has had millions and millions of dollars put in. Whereas a lot of Netflix shows, they have to put in the millions of dollars. So I think there's more negatives than positives. They do have that one positive. I'll say the key positive that they have is that a lot of the old TV viewers are still moving to streaming, because streaming just is so much better than TV at the end of the day. I watched some TV, I haven't watched TV in for the whole year basically. And I watched it for the first time a few days ago. It was terrible compared to YouTube and the absolute quality and all of the effort and the high competition that YouTube has. TV I can't even watch it these days. So, but that's one advantage Netflix still has, but then they have a lot of headwinds in their way. So I don't want to buy the stock. I want to buy a business that is wonderful. And I don't know if Netflix is still wonderful.